And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, the mind at TJ Stearns Inc., helping Chicagoland area savers and investors plan for and achieve that more stable, secure, and confident financial and retirement future. And if you've got questions, ladies and gentlemen, Tim Stearns is always here as your resource. You're welcome to be in touch. 800-640-2256, 800-640-2256. And with all of the questions and issues that we discuss on the program, Tim, I'm sure the most common that you address there at TJ Stearns is, am I ready to retire, or how can I know if I am ready to retire?
Well, the number one question that we get is, do I have enough money? And it's all about accumulation is what most people think. But I'll say to you this, I don't think it is about accumulation. What it is about is how much income can you get off of your assets. If I have a $5 million portfolio and I can only get 50 grand off it a year, what good is that, right? Versus if I have a $500,000 and I'm getting, let's say, $100,000 off of that, well, that's pretty darn good. Really, in retirement, what's it all about? It's about income. And so, we see this over and over where people are all hung up on the accumulation. And I get that as well. But you really need to figure out, how are you going to pay your bills in retirement?
It's that cash flow. That cash flow, the income is what our quality of life is going to be determined by, right?
Absolutely. You need to have cash flow. So having illiquid assets isn't going to really do you a lot of good if that's, where you're at. So we need to figure out that. And that comes back to, of course, having a plan, and having some assets that are going to throw off income, whether that's, dividend paying stocks or a dividend paying fund or an annuity or whatever you might have going on. It's about income and paying those bills and having the cash to do that.
Yeah. Tim, you mentioned those two different scenarios, the person with 5 million, the person with 500,000. And either way, maybe for the person with 5 million, like the running out of money in retirement may not be the top concern, but either side of that, I bet both want to be as efficient as possible with generating whatever it is that they need for income throughout retirement. And that's where that income allocation and that written retirement income plan, the Protect and Grow plan, come into play, correct?
Exactly. I mean, we're going to take into account what your budget looks like. And a lot of things that we're seeing are people that are winding down their careers, are thinking about maybe doing another a house in warmer climates, to going to Wisconsin and doing something or what have you. I mean, there's a lot of moving parts, and that calls even more for a plan. So even if you're just, plain Jane that you're going to be retiring and you need to figure out where your money's going to come from, we can help you with that. But if you're out there wondering, well, gosh, I wanted to really get a house somewhere else, what's the taxation like that? Our CPA works in all 50 states. So those are things that we help people get through. But having an income allocation plan is so crucial. 9 out of 10 Americans don't really have a plan, and they're thirsty for it. That is the number one thing you see in every survey, is that they want to have a point to themselves as a point man, where they're going to go next, having that plan.
Well, on this program, we will discuss how to calculate your retirement number, the reasons for implementing that plan to solve for it, the risks to your retirement income that you can specifically address, calculating the number, identifying the income gap, the equivalent portfolio value, understanding withdrawal rates and sequence risk. This is all part of the program and part of the planning process there at TJ Stearns Inc., with the help of certified financial planning professional Tim Stearns, CFP, author of the book Solving the Modern Retirement Riddle. And a lot of these issues are addressed in that book. And if you'd like to pick up your copy, available to the first 10 callers with at least $500,000 saved for retirement on today's program, pick up the phone and dial 800-640-2256. That's 800-640-2256. We'll try to get as in-depth as time allows, as we can here on the program, but a lot more information in that book, Solving the Modern Retirement Riddle. So again, be one of the first 10 callers to the program. You can get a copy in your hands. 800-640-2256. That's 800-640-2256. Tim, it strikes me that the day after we retire, it's not that we don't need an income, it's that we don't have an income. And the rest of the financial plan, with the status quo of how things have been done on Wall Street and in the financial industry, don't seem to reflect that fundamental change in the absence of a paycheck.
No, they don't. And the other thing that gives you pause is, what is a safe withdrawal rate, right? If I'm in 2022, when average portfolio we're seeing coming into our office is down 20 something percent, what is your true withdrawal rate when you're taking out money just to live? And you are a net seller of assets in retirement. The only growth you're going to receive is from the market. And in that year, that didn't serve you well. Probably the worst year ever in the 60-40, 60% stocks, 40% bonds, modern portfolio. So what do you do? And what is a safe, withdrawal rate? That all comes down to having a plan. And having a plan is so important when the market is down, even more so than if the market was up. An idiot can live in an up market, right? I mean, your portfolio's throwing off money left and right. But at the end of the day, when the portfolios they go backwards, they're losing money. They're in a bear market. What do you do? We saw that phenomenon in the 2000 through 2010. They call it the lost decade, where the market really didn't move.
Right.
Well, in those years, you're sucking money out of your portfolio. Trust me when I tell you, you were down because you had to take money out to live. So having a plan is crucial.
Do investors without that specific written income allocation plan know how much their portfolio will be able to produce in livable income and for how long, Tim?
They could do something on the back of an envelope type calculation, but when we do it, we get into exactly what that looks like. Where are you going to draw money from first? Do you take it from non-qualified money, like not your IRAs, not your 401ks, that type of thing? Do you take it from your Roth? And then that brings up another thing. If you're out there and you don't know what the Secure Act is, the Secure Act has definitely changed the landscape of what your retirement looks like if, God forbid, you and your spouse pass. So, these accounts have to be drained Roth or qualified money within 10 years. I marvel that even in my college classes, people are not familiar with that. They've heard about it, but they don't know exactly what that means. The one thing that everyone seems to know is that the required minimum distribution got moved to 73 years old now. Well, that's great. What if you're not here anymore? And I'll go one step further. What is your tax plan? You're going to be paying taxes. What are you going to do to mitigate that?
And just because we can wait a little longer doesn't mean that it's the best thing to do, because defaulting to the IRS's plan for us, Tim, I have not found often that is the plan that best suits and best benefits me. And that's what the RMDs are, is that we continue deferring and delaying until we default into the IRS's de facto plan for harvesting their tax dollars. Is that in our best interest? And it kind of brings up another point there. You mentioned which accounts to pull from first. That reminds me of like that order of operations test in math, where you had to know which kind of function to do first, second, and last in order to get the right answer. And here, the right answer versus the wrong answer is having money at the end of retirement or not. So do retirees without that specific written income plan, Tim, do they understand which accounts to pull from first, second, last, which order would be the most efficient to create the income?
I think most investors out there are kind of winging it, and they don't know that, they do a little sprinkle here, a little sprinkle there. They take something from there. Let's have a plan, and of course it has to be dynamic because life changes as it comes at you. But you need to figure out exactly what your order of operations are going to be. Peter, your operations can be different than mine and vice versa, right? So we need to figure out exactly what works for you. The one thing I've seen a lot of is that one spouse seems to be in charge of this, and my concern would be if you're out there and you don't have a plan, what happens if you're not here tomorrow? What does your spouse do? What are his or her marching orders? And what do you do next? What's the next step if you're not here tomorrow? You need to ask yourself that, because not having a plan is having a plan. And if you're not here and that other spouse doesn't know what's going on, that's scary, scary terrain.
Tim, it strikes me that we are reaching the peak right now of the baby boom generation. And this is really the first lump sum retirement generation, right? In that the generation previous to this now retiring generation really retired more on pensions. This generation has more personal wealth, more personal assets, and lump sum retirement savings than any previous generation has, because they've been Wall Street investors, because they've had those 401ks. And yet there's still more uncertainty about how to structure for retirement, and do we have enough, and are we in good shape for retirement despite that big lump sum. So I guess my question, we have a circle that is generally kind of like us, right? They're around the same age, around the same demographics, it's around the same income and affluence maybe. But, looking at the first wave of those baby boomers that retired, how successful has it been for them? How has it worked? What has worked well? What has not worked very well? You've seen that. You, as a CFP certified financial planning professional, have seen retirement many, many, many times over here for decades. Most people only see it once, or hope to only see it once, and therefore maybe haven't had the benefit of learning from other people's successes and failures. What are some of those differentiating factors that help the lump sum generation retire with more confidence?
Well, to your point, they were the first people introduced to a 401k, right? Pensions went by the wayside, and now they're dealing with, like you said, a lump sum generation. The money that they have on the last day on the job is kind of it, right? Unless the market grows. So what we found is that having a plan for them and figuring out a budget has worked, and has worked time and time again. And then shoring up loose ends like, well, what does the taxation look like? What if I go into long-term care and I need that? Do we get it on both of us, just one of us? Is there an age gap between us? And then the one thing that is really throwing kind of a wrench in the plan that is good and bad, longevity risk, right? We are living longer and longer, which is excellent, but we're living longer and longer without pensions, without legacy from our parents and that type of thing. So your concern here is to make that dollar stretch, and how many years are you going to need to do it? You need to figure that out. We always plan here for a 30+ year retirement. And many people sit there and go, well, 30 years, I won't be around that long. Well, my mother is in her 30th year of retirement, and my dad had 20 years of that 30 years. So those are very long retirements for people. You need to be able to plan ahead.
I also tend to think like, well, if we assume we're only going to make it 15 years and then we're wrong, right? That's a lot more painful. That's a
Right.
much larger mistake than if we planned to be 115 and we end up being wrong and not making it. That's not as painful of a oversight and error in planning, right? And kind of always examine those assumptions that our plan is based on, that our financial future and confidence is based on, and not just the age and life expectancy and longevity, but what about tax rates? What about inflation rates? What about market returns, right? All of these things are variables that are going to impact our outcome, and our outcome is only as good as the assumptions that we've made with those variables working out better than we expected and planned.
Right. And you measure 10 times, cut once when it comes to retirement. So when we sit down with someone, this isn't something we do in 4 minutes. We're sitting there and we sit down with them and kind of grapple with what they have going on, talk to them about their ideas and that type of thing, and then get down to brass tacks and figure out what do they need to make a go of this in retirement. And what happens if one of them passes and so one of the social securities disappears. I mean, that's a gut check as well. So maybe they need some life insurance. A lot of people, the baby boomer era, oh, I don't need life insurance. My kids are all raised up. Well, I get that, but your wife or husband is used to a certain lifestyle, and if your social security isn't there anymore or hers isn't, then now what? We need to figure that out. So these are all things. There's a lot of variables, and we put them all in the bag of tricks here that we go through, and we make sure that we understand exactly where we're going to go. And then guess what? Every year we meet and go over it again and make sure that we're still on the same path. You wouldn't try to figure out a way to go somewhere without getting the right path there using, Google Maps, let's say. that's what we're doing here is we're trying to get to that ideal retirement, which you and I talk about all the time, Peter. You have one shot at it.
Well, again, if you would like to speak with the author of the book, Solving the Modern Retirement Riddle, Tim Stearns, CFP, is available for you, helping proactive Chicagoland area savers and investors plan more confidently and successfully for your retirement future. Ladies and gentlemen, does offer both the book to callers to the program today, if you'd like to get your hands on a copy of Solving the Modern Retirement Riddle, or the plan, the Protect and Grow Written Retirement Income Plan. Both of those fantastic offers and valuable opportunities available as part of today's program. Just pick up the phone and give a call, 800-640-2256. That's 800-640-2256. 800-640-2256. And you can get in touch with the team there at TJ Stearns. By the way, you can also go online, tjstearns.com, always available online there. They hold classes at universities throughout the area, great learning opportunities for you, ladies and gentlemen, to better understand and get a handle on what it takes and some of those risks and issues and opportunities and variables that you'll face throughout your retirement. If you'd like to find out when an upcoming class is, just call that same number. And again, that book, Solving the Modern Retirement Riddle, for the first 10 callers to today's program with at least $500,000 saved for retirement. This book is for you. It's an absolute essential must read. 800-640-2256, the number to call, 800-640-2256. And Tim, I know you sort of said a lot of people, if anything, have just sort of done the back of the envelope math, but if you would walk us through that. Like I'm sure there are some people listening to the program today, even if they've been rather successful investors, maybe they don't even truly have that back of the envelope math done to answer, am I ready to retire? How do you begin that process of formulating the numbers behind an income allocation?
It's not that hard, right? You're going to figure out exactly what your expenses are, minus them by your guaranteed income that's coming in, your social securities, if you're lucky enough to still have a pension, your pension. I'm talking about guaranteed money that's going to arrive every month in your bank account. After that, you're going to have a gap, and then you need to figure out from there how long that gap that you need to fill it for, right? I'd say 30 years. So if my gap is 30 years times $20,000 or something like that, we're at $600,000 minimum that I need for retirement. Now, that's $600,000 net. There's taxes that have to, that are going to come into play there, because most of us, our largest asset is our IRAs or 401ks that we've built up over these years that we've never paid taxes on. So we need to figure out all that to make sure that you understand what dollar you're going to be getting at the end. How much of a haircut does the IRS take from you at that point? And once you're there, then you can figure out, well, I don't have enough money, or yes, I do. But I mean, I make it sound a little bit more simplistic than it is, because there's so many other moving parts. You have Medicare.
I mean, that's what I ask you for. Fair enough, because I asked for the back of the envelope. Yeah. So yes, we're oversimplifying here. But again, I'm sure a lot of people have not even considered that first part of it. And then please, yes, go into some of those complicating factors if you would, because now if we've done that back of the envelope, now we've got to kind of troubleshoot it, right? What about Murphy? What about all the things that can and may go wrong?
Yeah, the Murphy's Law says that there also is out there. This started about 5 years ago, IRMA, which is basically the surcharge that we receive on Medicare if we make too much in retirement. You also have that our taxes are going to go up after 2025, on pace to do that, right? Because the current tax bill that was put in expires at the end of 2025. What will your taxes do? Well, most of us in class concur that it's going to be going up. So now what you have taxes, you have IRMA, you have all these different things. A lot of people say, well, with Social Security, they're going to give me a cost of living adjustment. Well, last time I checked, it's sub 3% that they've been giving people over the last 15 years. And with that being said, inflation right now is pegged at around 3%. You're not even keeping up there either. So how are you going to keep up with inflation? You have to put that into the plan too. So there's a lot of moving parts, and we make sure we push into there all that. And then the last thing that I would talk about is volatilities in the market. If I have $1 million and I take a hit like a lot of these guys did that have come in to see us of 20 plus percent in 2022. Well, my withdrawal rate, I need to keep it safe. What is that going to be to make sure that I'm not taking out too much so I don't have enough money in retirement?
It's a fine line to walk and to balance, right? Is living the life that we want to live and spending the money to afford it comfortably so that
Right.
we know we're not going to run out of money before the end of the road, so to speak. And so the goal is to arrive at a conclusion about, have you saved enough to retire, how much you need to further build your savings, or creating that appropriate lifestyle that you can protect durably and dependably with the savings that you have. And that's the process of that protect and grow written retirement income plan, ladies and gentlemen. If you'd like to get that put together, pick up the phone, give Tim Stearns a call, TJ Stearns Inc. They are happy to hear from you, answer direct questions directly, and then set up a time for a complimentary, no cost, no obligation review, evaluation, and the strategy session to put that protect and grow plan together. 800-640-2256. That's 800-640-2256. Now, Tim, one of the biggest misconceptions in this process is that ROR, our rate of return, is equivalent or the same as the cash flow that we should be able to generate in retirement. Can you explain why this is a fundamentally flawed line of thinking?
Well, if it's in your IRA, that's flawed because let's say you say it's 6%. That's what I've seen a lot of people use, and they think they're being conservative, which is interesting. That's a whole nother discussion. But at 6%, if that's literally 6% in your retirement fund, that's not a true 6% that you'll get out of it, right? Because Uncle Sam hasn't taken his pound of flesh. So if I'm making, off $1 million, 6% per year, that's $60,000. Well, 60,000 minus the tax bill is what I'll be receiving net to me, right? So that doesn't exactly shore up my gap if my portfolio says that. So I actually need more money to draw off of to solve that equation right there. So that's something that we dive into with people to show them, hey, are you talking about a gross number or are you talking about a net number? Because it's totally two different balls of wax there.
And then, Tim, what about market downturns, right? It's easy enough to say, well, when my portfolio goes up 8%, I'll take out 8% for cash flow. Okay, well, with that line of thinking, using that logic, what happens when the market goes down 10, 15, 20%? Are you not taking any income and in fact putting more money back in to make up the difference that year? Because that's what that line of thinking would require in order to maintain and be successful, right?
Well, yeah, and that might work if I was still working, right? I'm still putting money back into the
But
bucket.
not when we're retired, right?
You're a
Yeah.
net seller of assets any way you cut it. So you
Yep.
need to be careful about when you're assuming things like that.
Retirement is an income first problem, isn't it?
Yeah, exactly. You need to have income to do anything that you want to do. And so to figure that out, you need to understand what your bills are, where you're going to be getting that income from, and what your portfolio can throw off as income, right? If your portfolio is, again, to the example I gave at the beginning of the show, if it's illiquid properties and that type of thing, where are you going to get your money for? You can't eat bricks and mortar. So at the end of the day, we need to figure out exactly what is going to happen when you throw off the money.
Maybe you could, but your teeth wouldn't be very good, right?
I would agree with that.
All right, Tim, it's time for our 5 questions here.
Sure.
Calculating your retirement number. Do investors without an income allocation know how much their portfolio will produce for livable income?
I don't think they do. That one of the things that we try to do is either show them a dividend type portfolio or even an annuity that will give them a guaranteed amount that will come out.
Do retirees without a specific income plan understand which accounts to pull from in which order to be as efficient as possible and optimize withdrawals and the longevity of their portfolio?
I don't think they do. Back to your example of order of operations, we need to talk about that. Where do you want to take your money from? We had a lady come in from the show who did not have anybody that she wanted to leave money to. So she didn't have an order of operations and didn't really care. Now, if you have a family, that's a whole different ball of wax, and that's a discussion.
Does Wall Street's 4% rule work better, or does an income allocation?
Income allocation, 4% rule fails 67% of the time.
And why do we need an income allocation then, Tim, to plan for an optimal retirement or to plan for retirement optimally?
Peace of mind.
Easy.
The only
easy.
way you'll have that is by having peace of mind, by having an actual plan that's dynamic.
All right, let's look at the market alternatives then, Tim. Does the Wall Street 4% rule work better with market-based investments or through that income allocation?
Through the income allocation.
Well, again, we have been talking with Tim Stearns, and we've been talking about that retirement number, ladies and gentlemen. How do you know if you have enough? The quintessential question, the one that I think that most people have on their minds, savers and investors, even conscientious, proactive planners that have been very successful in their investment progress and time span. Do I have enough? Have I saved enough? How can I make this money last? How can I be as efficient as possible? And then, Tim, what could go wrong? What maybe do I not have enough attention paid to in my plan that could be a possible hurdle or pitfall or unexpected surprise? All of those are addressed in the Protect and Grow Written Retirement Income Planning process, the strategy session that you offer there at TJ Stearns. No cost, no obligation for listeners to the program today.
Peter, thanks for having me. I'd love to talk to some people about income allocation. Having a plan is so effective in retirement.
And again, ladies and gentlemen, be one of the first 10 callers. Several are already gone, but we've got a few more copies of Tim's book, Solving the Modern Retirement Riddle. If you would like to receive one, just be one of the first 10 to today's program with at least 500,000 saved, and you can get a copy of Solving the Modern Retirement Riddle in your hands by author Tim Stearns, CFP. 800-640-2256, the number to call. That is 800-640-2256, 800-640-2256. As always, it's been a pleasure, Tim.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.